Hello, and thank you for tuning in for another Central Valley Economic and Housing Market update for the week of June 3rd, 2020. My name is Jordan Levine. I'm the Deputy Chief Economist here at the California Association of Realtors, and I'm excited to get into the numbers with you here today. So things are improving in the data, and we're seeing many positive signs in our survey of realtors that we do each and every week, and we've been doing it for the past roughly 3 months. We're also seeing that good news start to filter through into the market data itself when we look at California's housing market. And we're also expecting that things should continue to improve as well. So when we look at the numbers on pending sales and new listings, those numbers are moving in the right direction from where they were in mid-April. We're also seeing a lot of other sources of light at the end of the tunnel. So at least for the next couple of weeks, things should continue to move in the right direction. What about prices? We expect some price impacts eventually as a result of some of the negative economic impacts that I've reported on with you all for the last several weeks. And again, that is expected to filter through to prices, but with a lagged effect. The other thing, or the on the other hand point to that, is that we don't expect price impacts in the realm that we saw back in 2008 at this point in time, based on what we're seeing with things both gradually improving and just the better fundamentals that we had relative to where we were back in 2008, that the price impacts will be in the modest category of just low single digits for 2020. And yet, even as things begin to and continue to move in the right direction, it's perhaps more important now than ever to remind ourselves that that recovery process will be slow. There's still lots of multiplier effects associated with the job losses, the hits to retail spending and GDP that will continue to play out over the next couple of months. And so although we expect continued improvement, the economy will gradually open back up. We'll see fewer numbers of claims for unemployment, more mortgage applications, more pending sales listings. It's going to take a lot longer than many folks are hoping to get back to something that looks like quote unquote normal. In fact, most forecasters don't see us getting back to those long run trend lines until at least 2021, midway through the year. And I think that's a reasonable expectation. So let's talk about the realtor survey, where we have seen encouraging news. We've been doing this survey again for the better part of the last 3 months. When we talk about the most recent weekly numbers, we will be talking about the survey that we just concluded as I record this on Monday, June the 1st. And what we can see is that we're really past the peak, it looks like, in terms of both buyers and sellers holding back from the market. The percentages of folks who have actually had buyers not just get generalized cold feet, but withdraw their offer from a home that they had otherwise been ready to pull the trigger on, was down from almost 50% back in mid-April to less than a third of those sampled the week before last, that ended May 25th. And we see very similar signs on the sell side, with those numbers falling from almost 60% of realtors back in mid-April that had had a seller not just get cold feet, but actually pull their home down from the MLS. And those numbers have fallen consistently over the last 5 to 6 weeks to less than 50% of realtors that we spoke to again 2 weeks ago. We converted this over into a more weekly focused survey. So instead of asking cumulatively since the beginning of coronavirus, asking more about just what happened to you over the last week in your business. And we see that the percentage of realtors who have had a buyer withdraw the offer then falls to less than 10% of the market. And similarly, on the sell side, we see those numbers drop off to less than 1 out of 4 sellers have actually pulled a home down. And we will continue to monitor this over time as we move forward on a weekly basis. What's interesting is that you still see the sell side impacted more heavily than the buy side. And I think that still means that inventory will remain relatively tight. When you look at other sources of good news, we can see that more realtors are doing listing appointments last week. That number was up to 29% of members had actually done a listing appointment during that week, up from 27. So a modest improvement, but an improvement nonetheless. We saw that actually 23% of those realtors we surveyed actually got a listing and put a home onto the market. And again, that's up modestly from where it was 2 weeks ago. But again, another indication that things are moving in the right direction. We saw that 25% of members over the weekend reported that they actually had a home go into escrow. And that's been up for 3 weeks or 2 weeks in a row. We've been asking that question for 3 weeks, and that has continued to show signs of improvement as well. And in fact, almost 20% now had a home that actually closed. And that's again up from 15%. So incremental gains, but pretty consistent progress that we've seen over the last 2 to 3 weeks across a broad swath of indicators, both fewer folks backing out and more of these positive signs on listings, on pendings, and indeed members with sales that were actually closing. We also looked at the market data, and this stuff is showing up in the MLS as well. When we talk about the most recent week here, we will be talking about the week that ended Friday, May 29th. Of course, we see that closed sales are finding a bottom. And so when you look at the Central Valley, we saw decent impacts to the negative side. But by the midpoint of April, which was really week 16 and 17, we had seen closed sales stabilize. And in fact, as we got through the previous 2 weeks before the Memorial Day weekend, and you'll notice that we did have a bit of a drop off in closed sales last week. That is largely because we lost Monday. We only had 4 days with which to close transactions. But the first 3 weeks of May leading up to that, we had actually seen closed sales in the Central Valley gaining some momentum after they had really stabilized towards the end of April. And we're seeing a lot of other sources of light at the end of the tunnel. It's not just in terms of our realtor survey or the closed sales that we dug out of the MLS last week. We also see the numbers for showings, and Showing Time is an app that you can use to schedule your show times with your clients. And those numbers have gone from being essentially 60 and 70% below where they were when we started the year back in the mid-April timeframe to being just within striking distance of where they were at this time last year. In fact, we're 10% above the pre-crisis peak that we were at back in early March before the shelter in place, and we're only 1.5% below where we were at this time in 2019. So we've made tremendous progress after very significant impacts that kind of corroborate what we're seeing from realtors and in the MLS itself. We also see these numbers in the jobless claims, right? We've gone from a point in time where we are adding almost 7 million people to the unemployment roll weekly down to just 2.1 million in the most recent data. That's still a significantly elevated number of folks actually having to file for unemployment. But again, you can see that this number is also trending in the right direction. Consumer confidence, you can't really see a big noticeable uptick there, but actually we had a bit of an increase in May after one of the biggest declines in almost 50 years for consumer confidence. And so although we have lost a lot of ground and still have a long way to go to make up that gap, the data at least is showing that the declines have really started to decelerate and in fact move in the right direction across a whole slew of critical indicators as we measure this. That's not to minimize the impacts or to say that things are not challenging. They still are. They're just not getting more challenging at a faster pace. And indeed, when you take it a little bit closer to home and look at new mortgage applications, we're actually on our 6th week in a row nationwide of increased mortgage applications. In fact, last week's number was the first time, and you can see this on the right-hand side, where we surpassed the 2019 levels of mortgage applications. And that is, again, the first time that we've seen that kind of an increase overall since before the coronavirus outbreak really started to take hold with the shelter in place impacts. Here in California, things are actually growing at an even faster clip than what you see in the rest of the United States. We're on our 7th consecutive week of growth, so we're on the leading edge of that increase, but you'll notice here that we're still about 1.7% below where we were back in 2019. That's because we were hit harder during this first part of the shelter in place, but we're actually recovering that ground more quickly and are just right below where we were in 2019, a far cry from being 30 to 40% below last year's level only just a month ago. And we should expect that progress to continue on next week. In fact, if you look at the pending sales numbers for the Central Valley, the average number of homes that are going pending each day were up last week, even despite the holiday, and have made pretty consistent progress for about 7 weeks running. And so again, we see this in the realtor survey numbers. We've seen some of this action start to play out in terms of closings on the MLS, but you definitely see it showing up for the Central Valley when we look at these pending numbers, which again are trending in the right direction. The problem, of course, being is that we need supply to also rise to meet the occasion. And unfortunately, when you look at the Central Valley, the increase in the number of new listings, which we had been making significant progress on from mid-April through the first week or so of May, has really started to peter out. And you don't want to overinterpret last week's decline. Again, I think that was attributable to the holiday weekend. But even before that, we had 4 weeks of pretty lackluster growth in terms of new listings coming onto the MLSs there in the Central Valley. And so I think that in some ways, what we're seeing is a catch-up effect from overcorrecting back in mid-April and not necessarily the beginning of a V-shaped recovery, at least not for supply. And even as demand starts to come back in the Central Valley, we need those listings in order to generate the closed transactions that are going to turn about a full recovery. Prices in the Central Valley, though, have really not been impacted much thus far. In fact, if you look at the median list price on a per square foot basis, it was actually higher last week than it was before the shelter in place was even ordered. And so you see a similar effect on the closed sale side. We had a bit more mixed results. We did see some price softness there in terms of closed sales during the late April, early May timeframe, but over the last 3 to 4 weeks, we've seen actually closed sale prices trending up, and we ended last week on an up note from where we were even pre-crisis. So Central Valley, we haven't seen much impact either on the sell side or the buy side or the close side, if you will. And we know that sellers have been fairly reluctant to reduce price. In fact, in our weekly survey numbers, we've seen that really somewhere between 29 and 30% of sellers have actually, or of realtors have had a seller that reduced price in order to attract buyers. That's pretty much pre-crisis levels. That's normal from a percentage standpoint, and yet somewhere between 75 and 80, even upwards of 90% of realtors a few weeks ago had buyers who were expecting lower prices. And so there's this big gap in expectations, and we've decided to convert these questions over into weekly focus questions in order to assess in a kind of moving forward basis if this is getting better or worse, and just how this expectations gap is resolving itself. Because we see that just last week, still almost 2/3 of realtors that we talked to had buyers that were expecting lower prices. In fact, if you look at that same cohort of realtors, 10% had buyers that actually tried to renegotiate down the price on a home that they were already in escrow on. And so again, when you think about the sell side, only 29 or 30% have been willing to reduce prices since the beginning of COVID-19. Just last week, we saw 17% of realtors had clients that actually reduced price in order to attract buyers. And so it does seem like those buyers are putting the pressure on sellers in order to get those listing prices and, more realistically, the closed sale prices down a bit. We're not expecting 2008-esque price impacts. We just had a much more strong fundamental economy at the beginning of this crisis than we had back in 2008. but we do think that we'll see some modest impacts in the single-digit range to prices as the multiplier effects associated with almost 40 million jobs lost nationwide continue to play themselves out across the marketplace. And indeed, when you look at the percentage of active listings in the Central Valley that have been reduced, those numbers have been trending up. We're still only at about 30%, but they've been consistently increasing in terms of that number or that percentage of the actives that are below those original list prices. And we haven't seen as much movement on the closed sale side, but over the last 3 or 4 weeks in the Central Valley, we have seen that percentage of closed actually increase. So there was more closings that were happening below original list price over the last 4 weeks than we had been seeing even through early May. And so we do think that we will again see those modest impacts, but they'll just be in the single digit range as opposed to the double digit flavor that we had back in 2008. All of that being said, I do want to end with some words of caution because things are moving in the right direction. We've seen more positive news than negative news of late, and yet the recovery is going to take some time, especially to get back to that quote unquote normal level or those long run trend lines that we were at before. And so I want to take this opportunity to throw a bit of a wet blanket on the mostly otherwise positive news that I've been able to share with you this week so that we do have realistic expectations, at least for the next couple of months. And first and foremost, are those 40 million jobs that we have lost up till this point? We'll get new numbers in a few days, and I do expect that the number of folks applying for unemployment insurance will continue to trend downward, and yet we have over 40 million people in this country that have lost their jobs over just the last 2.5 or so months. And that is going to take a while, for the full implications of those effects to play themselves out. People had savings, they had government assistance that we could fall back on to mute some of the immediate blow. But this will continue to have ramifications for retail spending, people who are able to jump back into the housing market or make rent payments, bankruptcies, etc. And so even though these unemployment numbers move in the right direction, they will still continue to weigh heavily on our ability to recover, even as they also get better simultaneously. The other thing is, even if you only count just these 5 sectors that I'm showing you here, they account for more than half of all the 20 million or so non-farm jobs that we've lost. And so even if this 9.5 million bucket are purely driven just by the macro economy, and as things start to open up, those 9.5 million jobs come right back. 55% of the jobs that we've lost are in categories that will face ongoing restrictions. And so even as things start to get better, normal is still a long ways off. The other thing is we see that there's been a lot of hardship across the housing market itself, right? Somewhere between 4.2 and 6.6 million people have been asking to skip mortgage payments as a result of impacts and just not being able to get there, and that is painful. So even as these numbers start to trend back downward, we're talking about millions of households that have been negatively impacted by this as it comes to their actual pocketbook and just making that payment for shelter. And we see similar signs on the rental side, where we've gone from 93% of households last year staying current on rent to just 90, a little less than 91%. That doesn't seem like a big number, but with 43 million or so renter households, that almost 3 percentage point increase in people who are behind on rent payments represents another million or so households. And so when you put that all together, we're still facing significant distress out there. And that's why even as things move in the right direction, we still need to be very realistic about the fact that yes, things will continue to get better, but yes, they're going to remain challenging for the foreseeable future as well. And so, for my concluding remarks, I would just say that yes, things are getting better, right? We're seeing those sales numbers improve right alongside some of the forward-looking indicators, as well as in the external data on mortgage applications, on unemployment claims, on showing times. Those buyer demand numbers really have started to come back. But no, it is not time to celebrate. In fact, as I showed you, particularly when it comes to housing supply here in California, that the recent rebound we've seen on the demand side is being met with a rebound on the supply side that's really starting to lose steam and peter out. And so, in some ways, we're back to our age-old problem that we've had in California, the Bay Area, Southern California, you name it, where we've got more demand for housing than we've got available supply, and that is ultimately going to hold back the market as well. Keeping it really real, we have had deep damage done, and the multiplier effects associated with having 40 million people out of work will continue to play themselves out, even as the economy starts to open up and many of the indicators that we look at with respect to housing move in the right direction. And so, yes, we will continue to improve. Yes, we can be hopeful, but yes, the recovery is also going to be very slow. And of course, COVID-19 remains the wild card. And if we do have a second wave in the fall, then we'll have to come back and revise the more optimistic outlook that we have for you here today. So my message is to be encouraged. Things are moving in the right direction, but also expect it to remain tough because there's been a lot of damage done that will take time to work through. Thank you so much for joining me for this update. We will be back in a couple of weeks. Feel free to leave us comments and let us know how we can be more valuable in these analyses. And until then, stay safe, and we'll see you on the next one.